dollar goes up, then go down, right? So it cannot be like that. If dollar goes up and yuan also goes up, it cannot be happen. Okay, so expectation is that dollar will go up, and then after some time when you invest in China and you converting back to dollars, you will get less dollars, right? So it will affect bad or worse to your investment. Number two, explain how low interest rates in US can affect the tendency of US based MNCs to invest abroad. Similarly, if right now the rates are low, so what are the tendencies? Tendencies are higher that people will go to that country which offers you higher return, high interest rate. Simple. And the last one is, in general term, what is the attraction of foreign investment to US investors? So US investors, why they want to go to foreign countries? In order to earn more money. So answer going to be to attract to receive more returns. So the rate of return is basically the main attraction, but for some, like a minor, on minor scale, for some people it is diversification. So I was reading the Oliver's answer, there were diversification. So good, very nice, hedging and diversification. So very nice, Oliver. So Oliver, where did you go through this diversification and hedging? It's very, I would say advanced answer here. So have you gone through with this diversification and hedging before?
Yeah, but just with personal interest.
Okay, good. So diversification means don't put your eggs in one basket, in one basket. So it lasts. So for example, if you invested all in the US, if US economy goes down, your all investment will be lost. So it's better to invest in different countries. So all at the same time cannot be defaulted or cannot experience the recession. So if one country goes down, the other country will move up. So this is called diversification. It's a good answer. And that is more advanced answer. So good. So are we clear about this? Question number 12. Any question? Tiffany, Lancelot, PD. We have KDY. Who is KDY? Mina?
Oh, it's me, Dion.
Oh, okay. Dion, okay. Okay, and then we have Rujie. Understand?
Yes.
Good. Tora, Mina, any question?
No.
No, all good. Thank you.
Okay. Let's move. And now we talked about, okay, foreign direct investments also increase the flow funds. So now we'll talk about agencies that basically help or facilitate the international flow of funds. So right, banks basically help us to conduct transactions. Similarly, there are international agencies who help us to conduct foreign transactions. So our objective here is not to go into detail all of this stuff, just an overview regarding, okay, this institution purpose is like that. So no more their board of structure and other stuff. Okay, you don't need to go through in detail because that is not the objective of this course. Just going to give you a little example here, overview, that's it. So those agencies that helps international flow funds, number one, IMF, which is International Monetary Fund. So which is to promote cooperation among countries on international monetary issues. Among countries, which countries who signed up for IMF, who are the members for IMF. So they provide stability in exchange rate. How? We'll talk about here. So They provide temporary funds to member countries attempting to correct imbalance of international payments. For example, if a country is exporting less and importing more, so ideally, import and export if you are here. So remember, always remember that fix your point of reference. If you are here, for your export is sending goods to China, and for you import is goods coming from China. Okay. Ideally, imports and exports should be equal. But if exports are less than imports, it means you need to pay in foreign currency to China. It means you need to pay more yuan to Chinese. And if you don't have it, you go to third party, ask temporary loans from them. Okay, we need to balance our trade balance. So we need more yuan to settle our trade here, so that our investors, US investors, can pay to Chinese investors or Chinese businessmen. So in that case, IMF and other facilitating agencies, they came into play and they conduct transaction on your behalf, right? So here we go. So that's why they correct any imbalances in international payments. They promote free mobility of capital funds across countries. Promote free trade. It is clear from these objectives that the IMF goal is to encourage internationalization of business. So if you sign up for IMF, so you must sign up for free trade as well. There is no government tariff and all those stuff, right? So then I talk about here how they promote exchange rate stability. So in our previous example, we talked about that. Okay, what if we want the US need to pay to China more yuan and they go to IMF. And they go to IMF because they don't have yuan. So in US, demand, consider that yuan is just like a product, because you need to pay to Chinese, you demand more yuan. So in that case, demand for yuan goes up. It means exchange rate for yuan goes up. So in order to balance this kind of stuff, exchange rate imbalancement or exchange rate stability, the IMF, they issue compensatory financing facilities to its member countries. So CFF, which is compensatory financing facility, attempts to reduce the impact of exports instability on countries. So similarly, like line of credit in the bank, so you are old customer, more than have you have a relationship with the bank more than 5 years. So bank will say, okay, if any check comes to you more than your balance, so up to 10,000, we will support you. We will pay on your behalf, because dishonoring of check is considered very bad on your reputation. So it's like a loan that you didn't ask for, but bank will help you to provide so that your check is not dishonored, and bank will charge interest or minimal interest on that one. Similarly here, compensatory financing facility, if something imbalance happened, the IMF member countries, they don't have to present some kind of documents and all the stuff. The bank will on its own behalf, okay, some billions of dollars or whatsoever, according to your status, they will be issuing the currency on your behalf, and of course they will be charging some interest rate. The next one is special drawing rights. Now question arises, if IMF only deals in dollars, and if I need, for example, IMF says that I will only provide you in dollars. I don't need dollars, I need yuan. So then IMF in my country, in US, because I need to pay in yuan, people are demanding yuan. Yuan exchange rate is going up. Plus, IMF don't have the yuan. IMF also gather the yuan. IMF also create demand for yuan as well. So in that case, the rate for dollar will go down, and the US will say that, look, you know, okay, in outer side world, in Japan and in other countries, the exchange rate of dollar start decreasing, and the other countries will say that, look, we didn't do anything. Why the dollar is decreasing and our own currency is increasing? If dollar is decreasing, it means other currency is appreciating, increase in value. So Japanese government will say that we didn't do anything, and our yen started increasing, and we cannot export. Why? Because our products looks more expensive to the outside world. This is bad. So in order to resolve this kind of dispute, like IMF only prefer dollars. So what about euro? What about yen? What about British pound? Right? So they will say that, look, we didn't do anything, and because IMF transactions are not in thousands of dollars, they are in billions of dollars, 2 billion, 3 billion, 8 billion, $100 billion. So this create a huge impact on the market. So in order to remove this kind of problem, the IMF currency is special drawing rights. So what is special drawing rights? I have a small video so that you can easily understand what does it mean by, special drawing rights. So it is a basket of big currency, so that whenever IMF, give you loan or something, so one currency is not hit. So they have different basket of, they will give you a basket measured in special drawing rights. So that's why, so that, no single currency gonna be hit due to increase or decrease in IMF, transactions, right? So let's talk about this. Let me share you the video as well.
The Special Drawing Rights, or SDR, was created by the IMF in 1969 to supplement the official reserves of its member countries. The SDR is an interest-bearing international reserve asset that can only be held by the IMF, its member countries, and designated official entities known as prescribed holders. In addition to this role, the SDR serves as the unit of account of the IMF and several other international organizations. The IMF's financing arrangements with its member countries are denominated in SDRs. The value and yield of the SDR are defined using a basket of major currencies, which are selected due to their importance in the world's trading and financial systems. The SDR value is calculated daily, while its interest rate is determined on a weekly basis. The IMF Executive Board reviews the composition of the SDR basket every 5 years. This composition is revised to reflect major changes in the roles of various currencies in the world economy, and thus to enhance the attractiveness of the SDR as a reserve asset. In its most recent review in 2015, the board expanded the basket to include a fifth currency, the Chinese renminbi. The basket will now include the US dollar, euro, Chinese renminbi, Japanese yen, and pound sterling. SDRs are allocated to members in proportion to their IMF quotas and relative economic standing in the world economy. Every 5 years, the IMF reviews whether there is a global need for additional international reserves to justify a new allocation of SDRs. The most recent and by far the largest allocation took place in 2009 as part of the response to the global financial crisis. Currently, the amount of SDRs stands at over 204 billion. These allocations provide each member with on-demand access to freely usable currencies. Members can exchange SDRs for freely usable currencies from other members to meet a balance of payments need or to adjust the composition of their reserves. The SDR